Welcome to part 2 in this video series of trading gaps in stocks. This is Barry Burns with TopDogTrading, and in part 1 we looked at trading gaps in the direction of the trend. So we talked about gaps that start at the beginning of a trend, breakaway gaps, and then also continuation gaps such as this, where the trend has already been going for a little while. Here we've got 4 waves, and then it gaps in the direction of the trend with large volume. And we talked about the fact that we would expect a continuation rather than for the gap to close right away. Now today we're going to talk about the opposite. When will the trend end? So those two types of gaps are entries where we look to get in the direction of the trend. Now we're going to look at exhaustion gaps, which are gaps where we look to get out of a trade or to enter in the opposite direction of the trend. So here's an example of that, and you'll see that we have a very big gap here from way up here to way down there. So technically, sometimes people draw gaps, by the way, from the low of this bar to the high of that bar. Technically, you should actually draw it from the close of that bar to the open of that bar. That is your actual gap. So I've seen people do it both ways, but technically the gap is defined by the close from one bar to the open of the next. So that's very important, and I didn't discuss that in the last video. So that's how you technically analyze a gap and draw it markings. And then here again we have large volume. So large volume plays a point on whether we expect that trend to continue or, as in this case, to end. That's one thing. Now the other thing is that we want to be in an extended trend. So the first 5 waves of a trend are just the average. Average wave count today lasts about 5 waves. And that is basically higher highs, higher lows, not talking about Elliott waves here. So once it gets beyond that, then we're into an extended trend. We're beyond the norm of the probabilities. We're not trading the rule, we're trading the exception of the length of a trend. And this goes back toward the parable of, the saying, the trend is your friend until the end. So we don't want to trade the trend or in the direction of the trend at the end. We want to trade it at the beginning. And that's what your breakaway and continuation gaps are. Now, the exhaustion gaps are when the market trend gets, exhausted and it capitulates. And so then we look for the market to go in the opposite direction. This would be a trend reversal trade, and for it to come down. And that's exactly what it does. So that's the third type of trend. And there's a fourth type of trend, that's the third type of gaps. There's a fourth type of gap too called just a regular common gap that I don't think really needs to be addressed because it's not really tradable. But I do want to show you a type of gap that you should not be trading. So here are the type of gaps you don't want to trade. In fact, I don't really consider these technical analysis gaps at all. But you'll see this stuff. So, and we got a lot of little dojis, and even, look at that. That's just nothing. It opened, closed, high, low, all the same price. So you could, I guess you could kind of say, well, from this bar to that bar, there was a gap. Looking back from that bar to that bar, there was a little gap. From this bar to that bar, there was a little gap. From there to there, there's a gap. From there to there, there's a gap. From there to there, there's a gap. Even from here to there, there's a gap. Now, it doesn't look like it, but that is a green bar, so close there and open down here. It gapped down, but it didn't leave a gap on the chart, of course. And you can just get crazy with this stuff, right? And gap there and gap there and gap there. Everything's a gap. So when you see this kind of stuff, it's just too much. Okay, and again, gap from there. And so you can get carried away with this and start thinking you're seeing gaps everywhere. Okay, well, these gaps are not technical analysis gaps. So they're none of the 3 that I've described. Therefore, they really don't have any reliable meaning for trading. And there's going to be some markets that when you pull them up, and you'll see this especially with some, it would be both stocks, but I've seen this a lot with certain exchange-traded funds, ETFs as well, that they might even have a lot of volume. That's kind of the surprising thing. They might have a lot of volume, but then even on a daily chart, they like gap every single day. I normally don't trade that stuff. I just stay away from it because my entry, I want it to be very close to where my stop loss goes. And so if you have to include that gap in your risk, then that's not good because then I'm risking more than I really want to. All right, so hey, if you like this video, please understand, sure, it's free, but actually you do have a moral obligation to share it forward if you got value from it, and I sure hope you did. So please click the share button below and share it on social media. In addition, if you're watching this on YouTube, please click the thumbs up icon below and leave a comment. I love your comments. I'm giving away one of my favorite trade strategies. It's called the rubber band trade. It has a very high win-loss ratio, and you can get it right away. So I'm going to make this available, put a little icon there in the top left corner, or if you're watching on a mobile device, you can click the little eye with a circle around it in the top right corner, and I'll send you a video. It's about 26 minutes long, and it'll give you all the rules, the details for the rubber band trade setup. You can start trading that right away, although like most things, I do recommend you start trading with paper money and make it prove itself to you first. And of course, if you're not watching on YouTube, there's probably a link below or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.